Today, we will talk about bank capital. Bank capital is the net worth of a bank, and it is the difference between a bank's assets and liabilities. Think of it like the amount of money the bank would have left over if it sold all of its stuff and paid off all of its debts. Bank capital serves as a safety net to protect investors. This capital gives the bank the ability to absorb potential losses. It's important because banks play a crucial role in collecting people's savings and lending money to help businesses grow. Different countries have different rules for bank capital, but Basel I, Basel II, and Basel III are international standards that help make sure banks follow the rules. Regulatory bank capital is divided into tiers, which helps define how much protection bank capital offers to creditors. Common equity Tier 1 includes things like the amount of money from selling shares of the bank and the earnings the bank has kept. Tier 1 capital is the main source of funding for the bank, and it's used to measure the bank's financial health. The bank needs to have a certain amount of Tier 1 capital to protect its creditors in case things go wrong. This is a really important number when it comes to measuring a bank's financial strength. Tier 2 capital is the next level of funding for the bank and is made up of different types of things the bank owns that might not be worth as much when it comes time to sell them. This capital is not as reliable as Tier 1, but it still helps protect the bank's creditors. The book value of shareholders' equity shows the bank's total worth by subtracting its debts from what it owns. This is important, because the higher the book value of shareholders' equity, the more money the bank will have to cover its debts in case it runs into trouble. Here are 4 key takeaways. 1. Bank capital is the difference between a bank's assets and its liabilities, and it represents the net worth of the bank or its equity value to investors. 2. Basel I, Basel II, and Basel III standards provide a definition of the regulatory bank capital that market and banking regulators closely monitor. 3. Bank capital is segmented into tiers, with Tier 1 capital the primary indicator of a bank's health. 4. Creditors are interested in knowing a bank's bank capital as it is the amount they will be covered by if the bank were to liquidate its assets. Hope this would help. Thanks for watching.